How to account for slippage in options backtesting. Have you ever wondered how slippage can impact your options trading results? Understanding slippage is essential for anyone serious about options strategy backtesting. Slippage is the difference between the expected execution price of a trade and the actual price at which the trade is filled. In options trading, slippage can happen for various reasons, including market volatility, liquidity issues, and the bid-ask spread widening. This is especially true during fast-moving markets or major news announcements. When you backtest options strategies, accounting for slippage is vital to ensure realistic performance results. So, how do you do this? First, it is important to understand the nature of slippage in options. Options often have wider bid-ask spreads compared to stocks. Their prices can change quickly due to underlying asset volatility and time decay. Slippage can be positive, meaning a better fill price, or negative, which is more common. In backtesting, it is wise to assume negative slippage to avoid overestimating profits. Next, you can model slippage as a cost or price adjustment in your backtesting. This can be done in a few ways. One method is to add a fixed slippage amount per contract or trade based on historical data. Another approach is to use a percentage of the option premium or the bid-ask spread to simulate slippage. For example, when buying, you might subtract a portion of the bid-ask spread from the fill price. Conversely, when selling, you would add it to the fill price. It is also essential to use realistic bid-ask spreads and execution prices in your backtests. This means executing buy orders at the ask price plus your slippage adjustment and sell orders at the bid price minus the adjustment. You should also consider partial fills or missed fills if liquidity is low, especially for larger orders. In fast-moving markets, prices can change between the decision to trade and the actual execution. To simulate this in backtesting, you can introduce a delay between the signal and execution, adjusting prices accordingly. Additionally, if your order size is large compared to average volume, you should account for market impact, which can worsen slippage. Validating your slippage assumptions with historical data is another key step. Use historical intraday data or real trade execution data to estimate typical slippage for the options you trade. This ensures your backtest reflects realistic trading conditions rather than idealized fills. Finally, after incorporating slippage, adjust your strategy metrics. Key performance metrics like net profit, win rate, and drawdowns will be more conservative and realistic. This adjustment helps avoid overly optimistic expectations from backtests that ignore execution costs. In high-frequency options day trading, even small slippage per trade can significantly impact profitability. It is wise to use tight slippage models based on bid-ask spreads and volatility at the time of each trade. Limit orders can help control slippage, but you should also model the risk of missed fills. By accounting for slippage in options backtesting, you can simulate realistic execution prices. This includes adjustments for bid-ask spreads, market volatility, liquidity, and order size effects. Doing so will lead to more accurate and reliable strategy performance results, especially in fast-paced options day trading environments.